my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. I drew 9 weeks ago an early July to mid-November 2023 bearish Andrews pitchfork, which is highlighted in purple on my daily chart. At the time, it was more as a way of expressing the bearish angle of attack here than for anything else, and in this, it has been accurate in showing the way lower and the bearish angle of attack, especially in the middle of March, where I draw your attention to the high at 1240, which briefly touched the descending upper time, currently at 1180. Since then, the market travelled roughly parallel to the upper time, enough that I drew 2 weeks ago a fresh mid-November 2023 to mid-March 2024 bearish Andrews pitchfork highlighted in bright red on my daily chart. In this one, the market is at a slightly steeper bearish angle of attack, but the market was running parallel to this new upper time, currently 1154, and mixing it with a green highlighted short medium moving average, currently at 1181. The turn at the end of February and beginning of March was both surprising and amazing, as we really had no further support below until the 61.8% absolute Fibonacci line at 1106. So from the December 2020 low, prices turned back up, pushing through congestion in the 1161 area, then at 1161 to 1177, the 2021 low at 1181, the May 23 low at 1193, and the December 2021 low at 1223. Perhaps most important of all, prices pushed up through the green short medium moving average, and for a couple of weeks the market used it as a support, with the purple upper time as the resistance. However, 4 weeks ago prices started penetrating the short medium moving average on the downside, and also the May 23 low at 1193, the 2021 low at 1181 and the lesser Fibonacci at 1178. The start of the previously mentioned congestion between 1177 to 1161 that overall stopped the decline just over a month prior. We even saw the market push down below it and I discussed whether the action since November last year might be a descending scallop pattern, and the second option, an alternative where and I quote, the alternative is an almost immediate return higher and quick break, a proper break of the purple upper time. Right now that does not look possible, end of quote. Well, the market does what the market wished to do, and it chose the second alternative option. And firstly, last week punched up and closed over the bright red upper time, with most of that week spent mixing it with the green short medium moving average and the congestion around the 2021 low at 1181. And then this week utilizing the broken bright red upper time as a base of action for a push higher over the purple upper time, and even just over the next topside obstacle, the mauve highlighted declining medium moving average, currently at 1213. In the process, the market has set the scene for this week to also become a weekly key reversal. Thus, if we close Friday night either over 1178 or under 1165, then we'd be on. We are set to be a weekly key reversal up. So where does that leave us with regard to the descending scallop pattern? Well, we now have the opportunity for a significant move higher, but it will depend on prices clearing over the 1240 area overhead. If they do so, then target X at 1387 will come into the frame. Now, in addition to the resistances at 1223, 1243, 1271 and the band 1372 to 1399, we have what appear to be 3 significant resistances that are the gold highlighted declining long moving average, currently at 1280, and the 250% Fibonacci lines of the April 2020 to February 2022 move and the July 23 to February 2024 move at 1289 and 1316 respectively. What we have to look out for in the immediate future is whether the action since late January to date becomes a double bottom, as this will aid the move towards target X up there. But first, prices have to clear 1240, and soon. This leaves me with my final point, which I've raised at the start of the year, and I quote, "The only thing to bear in mind is not here on this daily chart, but in Chicago soybean meal." And that is the well highlighted annual key reversal down we saw there for 2023. Not directly related here, but not worth ignoring either. End of quote. Chicago soybean meal. After establishing a horn top in mid-November 2023, prices dropped with some hesitations and eventually reached the congestion down at 326.90 in late February this year. However, this congestion was different compared to earlier ones, as we had crossing through it at the time the extension to the lower trend line, currently 326.10, of the July to September 2021 descending triangle. I've highlighted this trend line in dark blue on my daily chart. Now, as I said 9 weeks ago, and I quote, "This may be nothing, but I'm minded after such a fall as we've seen last November last year that this may, just may, see some hesitation around the 327 to 325 zone. I'm not certain on that, but it's worth considering. However, the overall pressure is still bearish." End of quote. Well, prices utilised the extension of the descending triangle as a base and rallied back up through the 61.8% Fibonacci, absolute Fibonacci line at 336.30, and even briefly over the short medium moving average, currently 339.90, before succumbing to bearish pressure again, this time from the short medium moving average, and for a while this seemingly defined where the topside pressure came from. During March, it looked like all this was within a March-based bull channel, but that proved to be a mirage. Instead, I drew 2 weeks ago a very early February, late April sideways triangle, highlighted in bright red on my daily chart. Last week, while we had advanced quite a way along the coil of this triangle, the market broke up and outwards, pushing up through some resistances, most notably this week through the declining medium moving average, currently 352.80, and the congestion area 363.70 to 368.80, containing the October 2023 low at 366.40. I spoke on this matter 2 weeks ago, and I quote, "It is also even now a little early to give targets, but I can give an idea of the size of the moves in either direction. Thus, a confirmed break higher would have a primary target of US $21.90 above the break, and a secondary hard to reach target of US $42 even above the break." End of quote. Thus, we had a primary target of the break of 365.70, which was reached on Thursday, and we have a secondary hard to reach target X still open up in the 383.30 area. I'll only add the following comments, which I've done so 46 weeks ago and ever since, and I quote, "It was that the whole of 2023 was an annual key reversal down last year. This hangs over all of this market more than anything right now, and all action should be seen in the shadow of this pattern." That's the end of the quote. Chicago soybean oil. At the turn of the year, the market broke down through the 38.2% Fibonacci line at 48.95 that held up prices over November and December last year. The move lower was dictated by the overhead green highlighted short medium moving average, currently at 46.61. Prices went down to the area of the congestion we last saw in May 2023, consisting of 3, possibly 4 bands. They were at 44.68 to 45.04, made up of the 2014 high at 45.04 and a May 2023 low at 44.68. Then the 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line at 43.80 and the April 2014 high at 43.94. Then the interesting 42.65 congestion, we had the neckline extension, highlighted in bright red, running through it back then, and that's of the October 2019 to February 2020 head and shoulder stop, currently at 43.30. I mention all these because some 43 weeks ago and numerous times since, I said the following about the big descending wedge pattern that was on my daily chart back then and is now high up off the top of my chart. I said the following when I quote, "I would consider this descending wedge pattern may, just may have lately morphed into a possible scallop pattern." End of quote. This is a big pattern idea, and the market decline since autumn of last year fits in with this idea, with the expectations I voiced of eventually witnessing a fall down to the area of the May and June lows between 48 even to 46 even zone, which is where we've recently been. Now, I've often stated here that I am keeping a very, very close eye on this idea, as any significant breakdown below the 48 even 46 zone could signal the start of the rest of this move lower. I said 8 weeks ago, and I quote, "So far I'm not convinced of the move, that we've seen this break lower already. No, not just yet. However, 3 things to bear in mind. Firstly, this is a really big pattern stretching from November 2022 to date, so do not expect any immediate movements. Secondly, data indicates that about 3 out of 4 times the market breaks lower. Just be aware of that. Finally, I would like to float the idea of the recent unusual bear channel. And that's the end of the quote. Now, I've highlighted the bear channel dating from the start of 2023 in dark blue on my daily chart, currently 4084 to 4669. I had for a while utilised the green short medium moving average as the upper bear channel line before I drew a proper upper trend line. So it was that 7 weeks ago prices punched up through the short medium moving average, the first time closing over it since June last year. What is more, the market continued the rise and also punched up and closed over the upper bear channel line and the 38.2% Fibonacci line of the March 2020 to April 2022 move at 48.95, and also over the slowly declining medium moving average currently at 47.28. However, this was too much of a rise, and the additional forces mustered by the significant 38.2% Fibonacci line of that March 2020 April 2022 move at 48.95, plus the congestion area seen in December last year between 49 even to 51 1/4, eroded the move higher, despite consecutive closes over the medium, both the medium moving average and the 38.2% Fibonacci line. Enough that 3 weeks ago we saw the market close down back below the 38.2% Fibonacci line and the medium moving average, plus within the dark blue highlighted bear channel, and back below the green highlighted short medium moving average. Okay, so it looks like the dark blue highlighted bear channel has repaired itself somewhat. This negates part of my commentary from 6 weeks ago when I laid out some targets topside for the break above the bull channel, and I quote, so a primary target X would be in the 49.65 area, an area that we've almost reached, with a secondary harder to reach target X1 up in the 51.95 area, end of quote. Well, the market reached the primary target at 49.65 and reached it again and almost a third time, but that was all. And given what's happened since, I will retire target X1 after this commentary. So that leaves where we are now, within the bear channel again, but this time testing the bright red neckline below. The first time it's been tested since 2020. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.